Hey, welcome back. Right now we want to talk about trends, and we're also going to talk about trend tools and support and resistance based on chapter 4 in the book. But we'll just get through. We've got a number of slides here that we want to get through. The key point is that we want to talk about, okay, well, what is a trend? And then some ways of being able to capture that, some tools that are being used to try and capture changes in trend, and then support and resistance, because so much of what we do is centered. You know, we've said it already that the primary job of a technical analyst is to identify the trend so that we can trade with it. But there's so much of what we do is all around about finding out when these trends change. So let's jump in. And what is a trend? So prices basically move in trends. They rise and fall in trends. So you can see here we've got uptrends where there are, let me just move across, get my pointer working. So we've got higher peaks is the big identifier that we are in an uptrend. When we're in a downtrend, we're going to get lower troughs and lower peaks. And that is the key, that we're in a downtrend. And then the third state that we can be in is a sideways trend. And that's where you're going to see almost similar horizontal peaks and almost similar horizontal troughs. As per this example, it doesn't necessarily mean that every trough is going to be at the same level, but we wouldn't expect a new lower trough or a new higher peak to be going in. As long as they're constrained in a range like this, we would determine that to be a sideways trend. All right, I'll try and get my cursor back over here. Here we go. So what is a trend? Now, a great way of identifying this from a mathematical or algorithmic way is using linear regression. It's a statistical way of looking at all the data points and saying, okay, what's the line of best fit? What line best describes all of this data that I'm looking at? And so here's a couple of examples on this chart looking at linear regression. It's really important when we talk about trend that we really are talking about in the context of time. So similar here, you know, you can see the green line, which is about a year in duration. It's telling us that, okay, well, the trend over the last year is up. Because that's what the line of best fit is telling us. But then there's these two samples there in the middle around July and around October, where in July we had a sideways market on a monthly basis, and then around October we had a downtrend on a monthly basis as well. So the context of time is really, really important when we're talking about trend. You know, we can't just say market's up. You know, well, in what time frame? Are we talking daily? Are we talking weekly? Is it monthly? So trend is always in that context of time. And every analyst, you know, you've got to make your own decision about what time horizon suits you best. You know, I had an interesting discussion with an analyst who was working with a lot of fundamental analysts. Their decisions to invest were based on a fundamental basis. But then the timing of exactly where they got in and how long they stayed in for were more technical decisions. But typically their whole time was only the horizon of, you know, weeks. You know, once a decision was made, the technical analyst only had a week or so to make his decision. Well, it's no point doing technical analysis on monthly basis and projecting out where you think the price is going to be in months in advance when you're having to make those short-term decisions. So it's picking the time horizon that best suits the analysis that you're doing. All right, so what is a trend? Trend is a direction, not a straight line. You know, as you can see on this chart, it always oscillates up and down. Price always oscillates around the trend. There's always these corrections going on as we move up. Boy, our job would be easy if it was just a straight line. Straight line up, straight line down. You know, it make trading so much simpler. But that again is why we're employed, to be technical analysts and work these things out. But do please remember that it's not a line. Because we use trend lines, and we're going to show those in a moment, a lot of people can get a bit confused about that. The other thing that we do as technical analysts is classify trends into primary, secondary, short-term, and sometimes intraday. This was a method coined first of all by Charles Dale in the 1890s when he first started drawing charts back then. Typically the primary is what we see in years, sometimes months, but it's the long-term marker. What is the primary trend of Microsoft? Is it going up? Is it going down? And then we look at that, and then we can talk about the secondary trend. And usually that's in weeks, sometimes up to months, but typically weeks. You know, there can be some short-term downtrend that we're in at any point of time. And then when we get down into the daily basis, we can talk about the short-term trend. And so, you know, what's that measured in? Now, for doing the exam, you need to know this whole concept of primary, secondary, short-term, and intraday, and really know the rough times of how long these are measured by. You need to be able to, you know, in the exam, you're probably not going to get a chart and say, well, is the primary trend up or down, but really do have a very good understanding of these terms and what each of them mean. All right, trend classification, continuing on there. So what I had to do with this chart was stop in July. As I said, you know, trend is in the context of how far I'm looking back or the time frame. So in this chart, again, my yearly time frame, going back a year, the trend is up. But then when I look at the blue line there, which is the secondary trend in this case, I would say that it's sideways, starting to look like it's going down. But then when I look at the short-term trend, which is that last little red line, only, you know, a week of data there, you would say it's sharply down. So again, it's that context of the different trends. The question often is, you know, we get asked is, does the slope of the trend line matter? And the answer is, well, not really, but yes, within the context of other slopes. So for instance, if we have a market and the primary trends normally go up consistently and down and everything's, you know, pretty standard, but then we get a sharp move and the slope of the line is much, much sharper than we've ever seen before. Well then yes, that's very significant. And we'd be paying a lot of attention to that move because it's something which is abnormal. A lot of what we do as technical analysts is to look at charts in the context of their history to sort of say, is this expected behavior? Is this something that I've seen before? Is there an outcome that has happened 6 or 7 times out of 10 before that I can extrapolate forward and help me in my analysis of where I think this trend is going? So yeah, you know, the slope does matter, but we don't put a definitive value behind it. The thing about trend analysis and particularly trend line is that we're very subjective about this analysis. It's not a quantitative objective process, not at this stage. You know, we are working on ways that we can do that. It really is the art part. You know, we've said that technical analysis is part art and part science. A lot of these kind of concepts are the art part of technical analysis, and so it's really important to keep that in mind. You know, technical analysts can make really profound statements of fact, but you know, so for instance, even a RSI-based signal, and if you don't know what RSI is, we will talk about those in the coming weeks, but an RSI-based signal may work perfectly, absolutely fantastically for a season. Author can write a book about it, go and do presentations and speak, but then over time, what I've seen and what many others will attest to as well is that these sorts of strategies, they work really well and then suddenly they roll off and they don't work quite so well anymore. And that's where, you know, whenever you read things, whenever people are talking about signals, even the signals that we talk about in this course, you've really got to take that in the context of, well, okay, that was at that time, let me now test and verify, does this strategy still work for me now? And so, yeah, it's important to understand all of that. As we get more quantitative, actually, part of our goal at Optuma is to really quantitatively test and keep retesting so many of these techniques. We'll be able to work out whether some of these long-held beliefs will continue to hold true or not. The key for profits, again, very important for the exam that you understand this slide. Every technical analysis signal is centered on capturing the trend. Mentioned that now plenty of times. Our goal as a technical analyst is to determine with a minimum risk of error when a trend has begun at the earliest time and price. The quicker we know, or we can make an educated guess that the trend is changing or has changed, the quicker we can get in and participate in those gains. And so that is the key to profit, is identifying the change in trend. We need to select and enter a position in that trend that's appropriate to the trend. So if we were trading secondary trends, something that Dow wouldn't recommend, but if we were and we saw that those trends typically lasted 1 month, we wouldn't be taking a massive position and expecting to hold it, particularly if it was a position that took us a couple of days to roll into. So the positions that we take need to be appropriate to where we think we are. If it's a continuation of a primary trend, but the primary trend has been going for a long time, we may be a little bit dubious about putting everything in. So those are things to watch. We need to close those positions when the trend is ending. So just as we use analysis to find the beginning of a trend, we need to be looking for the signs that the trend is ending or the beginning of a new trend. The more objective and rules-based we can be, the better. We need to be able to take emotion out. There's many traders that I've seen and worked with that had fantastic rules, but as they allowed their emotions to get involved, the rules went out the window. And so very important that we be very objective and very methodical about our trading. The best traders that I've met over the last 20 years have always been those that are very highly disciplined. So, very important as well. Sounds all simple, but it really is the basis of technical analysis. When we distill everything down, this is what we're all trying to do, is to capture those trends and get those capital gains. All right, determining trends, as we said, linear regression is a great way. It's not really the standard way that we would do it. Typically when we talk about trends and trend lines, it's by observing the peaks and troughs on the chart. On this one, we've just put on a little tool that identifies peaks and troughs, and so just so we can mark them. As I said, price is going to do oscillations around the larger trend, and looking at that one. So what we've got is a trend line here that we're drawing in. And so what we're looking for with trend lines now, whenever the trend is up, we draw our trend lines underneath the troughs. We're looking for higher troughs, and we're looking for a break, for a low or a trough that is going to break through that line. And so that's why we have our trend line coming up underneath a rising market. If the market was falling, then we do the opposite, and we put the trend line on top because we're looking for peaks that start breaking through that trend and giving us an idea of a change in trend there. If it was sideways, we'd actually connect both, the peaks and the troughs, because we're looking for a breakout from that range. And we talk a lot about that in the section on chart patterns. Trend line analysis is not an exact science. It's really a little bit of fudge. I almost think of it as a zone rather than a hard barrier. And so, we really want to put those lines there. I actually like candles. Actually, I think that's on this next slide. I like using candles because if the shadow and the whisker goes through the trend line, we don't really care too much about that. It's when the body breaks it that we really want to pay attention, particularly if it's closed beyond the trend line there. In this case here, this one's actually a really interesting one, because remember, for Upward trends, we're looking for successive troughs to join our trend line to. In this case, we actually had a break of our trend line, but there was no successive peak. You know, you can see here that we've got our first break. This is still a higher peak, and then we get our breakthrough here, but there's no lower peak that we could possibly draw a downward trend line through. So in this case, we actually didn't get what I would call a break in the trend, a confirmed break. So the candles going through it broke our trend line. It's almost like, hey, early warning, we've got a change of trend possible here. What we really would have needed to see was a successive lower peak that we could now start to put a downward trend line on, and that would then really confirm, yes, we are in a downtrend, and let's put our line there and look then for a break. So in this case, no confirmed break of the trend. We would still call the trend up until we had that confirmed lower peak. All right, so we have an example of a downtrend there with the lines sitting on the peaks, and also an example of the trading range there. Again, I think we talked about this last week. It doesn't necessarily mean that the troughs will go all the way down. It's just saying that we're constrained. We're constrained within this range, and we're looking for it. Incidentally, you know, a lot of the early chartists, when they were doing this type of work by hand, they would look at how long the market was being constrained in a range, and the longer it took, their rule of thumb was always the greater the reaction out of the range. So when we had a breakout, we would get a target which was related to how long we were in the range. Point and figure, we still do something similar. We'll talk about that. We don't really talk about it much anymore in technical analysis, but still a handy one to keep in mind. When you see a market that's just continually constrained, once you get that breakout, well, the size of the reaction can be proportional to how long it stayed stuck in that range for. Another concept that you will come across, you'll need to know, internal trend lines. It's simply a trend line that goes through the middle of the price action instead of being underneath. I mean, it's a great way, again, like linear regression, of just saying, hey, we're in an uptrend. Look, here's the line of best fit. It's really a manual way of trying to do a linear regression line. I'd prefer to use linear regression, but you do need to understand and know what an internal trend line is. All right, couple of rules about trend lines. These are rules of thumb that we all adhere to. The more times that a trend line is hit, obviously the more significant it is. And so if I've got a line that, you know, I just drew between 2 points and then nothing ever touched it again, you know, a break of that line doesn't really mean much. But if I've got a line and it's been hit by 5, 7, 10 troughs as the market's been going up, well, when that line gets broken, boy, is that significant. You know, that's really important for me to pay attention to. The steeper the line, the sooner it will be broken, is another rule that we have with trend lines. So, you know, let's take the extreme example. If something was just going straight up, well, you don't expect that to be sustained. You know, those sorts of markets don't happen for very long. Even in the manias of 2007, or go way back into the 1600s, the tulip bulb mania in the Netherlands, those things don't last. And so you get these bubbles and bang, you know, it rolls over. But the same thing happens, you know, again, we talked about the steepness of trend and the steepness of the trend lines. If I've got a market that normally goes up at a slow, steady pace, but suddenly we've got this really sharp rise in the market and the trend lines are there, I wouldn't expect that to last as long as the slow rises. So, you know, we keep an eye on that as well. We should never consider a trend line as exact. You know, I can't keep reiterating this enough. You know, it's very important that we don't treat this as absolutes. Accelerating or logarithmic trend lines. So one of the concepts we do, you know, we talked about arithmetic charts and logarithmic charts. We can apply the same type of principles here, trend lines, and the idea is that as price gets higher and higher, well, I need to make my lines steeper to accommodate for that. And so a way that we can do that is with logarithmic trend lines. Now, you'll see the green line here is curved. Both lines are using the same start and end point. Let me bring my cursor across. So we've got our start point here, obviously for both. Both of them were drawn to this low here, but the green line is logarithmic. And what that does is as price is rising, it's staying closer and closer. Now the advantage is you can see that in this chart here, the blue line hasn't even been broken yet, but the green line was broken months ago. So it's given us early warning of a change in trend by keeping it much closer. Now, if we were looking at a logarithmic chart, well then the green line would be a straight line and the blue line would have curved down because it was a linear calculation. But again, just a way of doing accelerating. You've got to understand what logarithmic will do to a trend line and how you adjust for that as well. All right, so let's go look at a couple of tools on trend lines. We're going to look at a couple of different ways that we use technical analysis and tools to help us identify trend line breaks and know while we're still maintaining the current trend. So the first one is channels. Now, like we said, trend lines don't move in a straight line, or trends don't move in a straight line, I should say. And so they appear to travel in these channels. So channels are a nice way of being able to do this. Put a lower boundary and an upper boundary, and you can look for breakouts, because sometimes the trend may be up, but you actually get a breakout to the upside, which is signifying, some changing conditions, and it may be that this, even though we're a long way into the trend, there may still be more buying opportunities going on. So again, look at that and watch for that. The other thing to watch with a channel, and this can be early warning, and I don't know if this example is necessarily giving it. I guess if I had done let me bring my cursor over here again. Where's my cursor? If we had drawn the top of our trend line through this point or our channel, the thing that would have been really noticeable is the fact that this peak didn't reach the top of the channel. And so this is a use of channels. When I've got that top boundary, if I've got peaks that aren't making it to the top, but they're still bouncing off the bottom, it's giving me really early warning that, hang on, there's a little bit of weakness here. The bears or the bulls or the buyers aren't able to push that price up into new highs, and it could be really early warning that there's a change of trend to be expected. So I'd be watching for a break of the bottom trend line under those conditions. And you can see it here, in this one where we have, basically it's what we would call a double top, two tops or two peaks at the same price. And that's really starting to tell us, the bulls couldn't push it higher. Let's watch out for any sort of move on the downside there. Let me just make sure I've covered all of that. Yeah. The other thing is to watch for volume. Now, often we put a volume chart underneath our bar chart. So what we can see here is how much volume, how many shares traded hands this day, how many contracts changed on a futures contract. And we look at how all of this relates. Again, it's on a relative basis. We don't look at this and say, oh wow, Microsoft had 10 times more volume than Facebook, so it's significant. No, that doesn't really matter. What we want to know is, compared to the history for this security, is volume up or is it down? Because there's so much information that we can gain out of that. So one of the rules we use with trend analysis is that high volume confirms the trend or confirms the reversal. So when you look at this chart here, again, let me bring my cursor across. We've got these blue zones. Now, I've drawn these blue zones wherever we had a peak in volume. And the thing about these blue zones is that they were all lows. So every peak was in a low, or mostly a trough, or at least a downward bar. The price was going down and the volume peaked under those conditions. That's telling us that there's more sellers, and the sellers are pushing the market down. It's confirming the downward trend. So again, as we said, the volume confirms the trend. But then we get to this situation of the red bar. The price is continuing down here. We get this small run up, but if you look at the volume didn't confirm it. The volume was sinking under this move up. So again, we would say, still not good. We get a couple of down bars and the volume spikes again. Again, it's confirming to us the downtrend. But then suddenly this bar after this red zone, we see some bars here where the price is going up and volume's increasing. This is key warning to us that the trend is changing, and that we need to look for confirmation of that change in trend. Again, I've got the question mark there. Is it a change in trend? The aggressive trader, the aggressive analyst would say, change in trend, volume's confirmed it, let's go. The more conservative would wait for confirmation or use some other signals to confirm that. But as I said, volume, very important, can be used to confirm those changes in trend. So when we have a trend up or a trend down, as in this case here, there are all these moves, a secondary trend. So we have the primary trend up. Well, the secondary trends in that situation would be called retracements. And so when we look at this chart here, we've got, let's say, the start here. We've got a trend running down. And so we can see our peak. We go to our trough here. And then we have what we call our retracement. Now this can happen in bull and bear markets. So in an upward trend, the retracements would be down. In a downward trend, the retracements are up. In this case, we can see that our retracement, the tool's telling us, is almost 70%. And so we can look at that. Now, again, a couple of things about trends. When we start to see retracements getting bigger and bigger, then again, we're looking at this saying, oh, gee, I'm not so sure. So even in this chart here, actually, if I look at this, we've got a 70% retracement. If we think of our next move down to here, and then our retracement back up, I mean, this retracement's almost a full 100%. I would be very concerned about this. If I started seeing, greater retracements, again, I'd be looking for an end to that downtrend and the beginning of an uptrend coming along here. So, as I said, we always measure the retracements in terms of the impulse beforehand. And again, impulse is probably more an Elliott term, which we'll cover a little bit later on as well. All right, where is my cursor? Fibonacci retracements. Another way of measuring these. Now, Fibonacci, mathematician in the 1400s, I think, maybe even earlier. He had this whole mathematical cycle. So, he had this number sequence of 1, 2, 3, 5, 8, 13, etc., where the previous two elements were added together to get the next element. Now, when you did that, and especially when you get out to the bigger numbers, the ratio between those numbers from, let's say, 8 to 13 is actually 1.618. So you multiply 8 by 1.618 and you get almost 13. As you get to bigger numbers, it gets more exact. But when you look at all the different ratios and the relationships forward and the relationships back, you get then this 382 and all of these sorts of numbers that work out in that sequence. Well, what we've found is that in nature, Fibonacci happens in lots of things. We can go from one hand to 5 fingers, and we start to see those same sort of proportions in facial structure. We see all of that as well. It just seems to happen in nature over and over and over again. Nautilus shell, another great example of that. When it comes to markets, there seems to be this same sort of expansion and contraction relationship using the same sort of Fibonacci number sequence. It's always amazing when you look at prices and you look at thousands or millions of people making trading decisions, how a lot of that can reflect out and be represented using this same sort of expansion and contraction idea. So when it comes to these charts and when it comes to trends and looking for reversal points and significant points, Fibonacci is an important way that we do that. So looking at this chart here, you can see that we've got this move down. So we're coming from the top, is where we started this, we measured down, and then we draw in these lines. We've got a 38% retracement, a 50% retracement, and a 61.8% retracement. Now sometimes some people will flip those around and they'll actually say, well, this is the 68% mark. And the reason they do that is that they're working on this model of, well, if this was the move down, then when it comes back up, that was back up to the 68% mark of the previous move. So, you know, that's why you can sometimes see them flipped. So just having a good understanding of this. But again, it is this whole thing of, you know, this market here, the gold index at this time, actually, I don't know what it's done since I said this chart, but what I'd be looking at there is for that to continue down. A couple of real key things. We've got a established downtrend there. It's come up only as far as the 38% mark and then just fallen away rapidly again. So we'd be looking for that market to continue down and to follow the downward trend. There's nothing there to tell us that it's broken. Now, if I started seeing subsequent moves down, having retracements get to 50 and then to 61.8 and then break that as well, then we'd be looking, saying, oh, hang on, that downward move is starting to run out of steam. All right, so now let's jump into, let's find my cursor again. Okay, so we have speed lines. So these were developed by Edson Gould. Basically, when you look at the Fibonacci tool there, we still start our, we take this starting point where we started our Fibonacci calculation from, but then we also draw a trend line through the ends. You know, wherever our ending point was in time, basically that will be where our Fibonacci lines are, and we just draw lines through them. And you can see how these ones work. You know, they become these really interesting points of support and resistance in the market as time goes on. So just a nice little tool there that you can use. Another variant of that is Gann fans, developed by W.D. Gann. What he was doing, obviously using graph paper at the turn of the 20th century, he would just measure out and say, well, if I've got my grid, I'll go out one box and then one up, and that's my 1 by 1 line, or 2 boxes out and 1 up, and that's my 1 by 2 line, or 2 up and 1 across, and 2 by 1. And so he would do that, and he would again see these patterns forming in the market and just find that these lines created support and resistance zones and areas where the market seemed to reflect. Often with this type of analysis, what you're looking for is a market that has respected lines in the past, and then you would say, okay, well, I've got a certain amount of conviction that if the market's respected these lines previously, it's going to continue to do so in the future. Nothing's a certainty. Nothing about technical analysis is absolutes. You know, we are looking for probabilities. We are looking for different techniques that give us a probabilistic, that's a mouthful, idea of where we think trend's going to go and identifying breaks in trend. And so that's with all of these ways. But the Gann fan is actually a good way of identifying trend speed. You know, it's a way of quantifying that as well. Just a quick note there, they're not geometric angles, they are actual calculations. Very interesting concept, the way that we work with time and price there. If you ever use these, the intersection points are the most interesting when you have two Gann fans, and you can see a couple of intersection points there on that chart from two previous fans, yet the intersection points in the future were all very interesting, and I didn't even highlight all of them there. Another one worth noting is Andrew's pitchfork. So the way that pitchforks are drawn is that we start at the bottom. We're looking for our first impulse move out of the market, out of the change of trend, and our first secondary move. And so we start at the beginning of the primary trend, we go to the beginning of the secondary trend, and then to the end of the secondary trend, and then these channels are drawn. And again, you'll see how they become these really interesting areas where the market seems to respect them as it continues on. We can add extra lines into that as well. And again, we've got these zones of support and resistance there as well. You know, the reality is that even these extra lines, you know, Andrews himself didn't add these in, but what I would often say is that we stand on the shoulders of these technical analysis greats that went forward and forged these new ideas, and we can build on them, and we can start looking at this and start working in a more quantitative way to put all that together. So already today I've talked a number of times about support and resistance, so let's dig in a little more about that. In its purest sense, support and resistance is really looking at places where buyers and sellers continually agree on price. You know, again, economic theory tells us that every price in the market is just where buyers and sellers agree that a security should be valued. And so, you know, that's what we're looking for. We're looking for that balance. Aggression is a factor as well. Sometimes, you know, there can be a lot of aggression on the buying side or the selling side, and that can push markets quite rapidly as well. So resistance is basically a peak in the market where the number, or the aggression, if you like, of sellers has grown to balance the number or aggression of buyers. So if I've got a lot of buyers, or they're really big buyers, and they're pushing the market up and there's not many sellers, well then the price is going to go up. But as the price continues to go up, well then there's more and more people who are holding the equity, the security. They're going to say, hang on, this is a nice tidy little profit, and yeah, I may have some capital gains issues here, but you know, I want to lock in some profits. So suddenly the sellers start to increase, and the buyers, well, the price has gone up, and suddenly, you know, based on, even if it's on dividends, my earnings per share value, you know, it just doesn't make, my price to earnings ratio just doesn't seem to make as much sense anymore. So maybe I want to not buy anymore. So you get this equilibrium that happens. Now, if that keeps happening at a certain price where the buyers push it up, then the sellers come in and lock it off, well then we say that there's resistance at that price. There's resistance which is stopping the price from going any higher. And so that's what we define as a resistance zone. Similarly, support is the opposite. Sellers may be pushing the price down. There's not many buyers there, but as it gets cheaper and cheaper, well then buyers are coming in saying, hang on, I want to buy this share as well. Sellers may be looking at the price and say, not worth selling, I may as well hold on to that and hope that the price comes back and I can sell it further down the road. So again, as price keeps coming down and keeps hitting that level, we would call that a support zone as well. Now typically, when we think of it in the simplistic sense, we're talking about prices that are resistance zones and support zones. But as we talked about, even in channels and some of our other tools as well, we talk about them being support and resistance as well. You know, we can have an angled support where the price is going up, but it keeps hitting it. And really that's like the sellers who maybe last month were saying, I'm going to sell this down because, you know, this is getting too high. But then as time goes on, oh, well, you know what? The price has gone up. We're going to let that go higher before we start selling because I want to get more profit out of this trade as well. So support resistance isn't just fixed prices. It can be on angles as well. So here again, you know, a good chart with a range here. Previous peaks and troughs have a habit of stopping the market in the future. They become zones where there's a high probability, and I think that's the important thing. When you see a price or previous peaks and troughs continually forming around the same levels, it's a high probability that when the market approaches that in the future, that you're going to have that same issue there, or that same turning points happening there. The reasons, so there's a number of reasons. You need to know these reasons as well. Recency bias, you know, a lot of us are looking at, we saw the trend change at a price, and so we're watching to see it happen again. You know, as the market comes down to that level again, a lot of people sitting on the sidelines saying, oh, what's going to happen? This is part of the reason why volume seems to fade off on some of these, you know, especially in a range like this. As the range gets longer and longer, volume peters off, and then once we get a breakout, then everybody's back in again. So important to watch volume as well. Even if we didn't get a reversal at one of these support zones, usually we'll definitely get a pause. So as we come back to previous turning points, there'd be a pause in the market while people are waiting and seeing, and then if it continues down, then great, everyone's back in again and continues on. One of the other reasons for this is exiting. Let's say price was falling, bought, or let's say at a peak. So price was going up, I bought, and then price fell down. When price comes back up, I'm just like, oh wow, I dodged a bullet, I'm getting out of the market. And obviously there's a lot of that. You know, whenever you've got people making right decisions, you've got people making wrong decisions. And so there's a lot of people exiting. It's again, one of the reasons why we have support and resistance in the market there. Second chance, you know, I missed the last opportunity to go short, let me go short this time when we get a peak is another reason. And then large institutions, you know, there may be a mandate, let's just say a huge trillion-dollar company that is buying into a position. You know, normally when a large company buys equities for their funds, they're not buying them and then throwing them out the next day. You know, these companies are taking days and weeks sometimes to scale into positions, and then they're going to hold that position for months and months at a time. So when the price comes down in a security, the analysts are looking at that and they're saying, wow, that's really good value based on the dividends, based on where I think that company is going to go. I actually think that this is a really good company to invest in. We're a buyer at $5. And so whenever stock's getting into that range, they're adding to their position, they're adding to their positions as it goes. Price goes up, they stop adding. And then price comes back down again, and let's add more to our position. So it's another reason why you get these zones. Once they've filled up their quota and they've got the portfolio weight that they're after, well then obviously they're no longer a buyer, and then price can fall and break out of that range as well. These are just some of the reasons why these ranges happen. You know, we're a big believer that, you know, we have to have this understanding because it helps us in our analysis. No matter what technique that we're using. All right, all those reasons are psychological, but they've been evident in the market for decades. The way I like to think about support and resistance is more like spongy zones rather than hard and fast barriers. You know, small breaks, again, candles, shadow breaks, whisker breaks are really not important. What we're really looking for is breaks of bodies and things like that. When we see these peaks and troughs repeating, we know that we're in a zone like that. Already mentioned this, the longer that we've been bound in a range, the bigger the move out will be, because everyone's just sitting there waiting for that breakout. All right, couple of ways of doing calculating and identifying support and resistance zones. So in this case here, you know, we've got these three peaks that we've identified. There's not a really clear one price. So then what we end up doing is start to create a zone, you know, particularly if there were, I'd prefer to see more than three, but this was just a great example. And so we create this zone and we're looking at this range and saying, okay, well, we expect anywhere from the lowest to the highest peak there that we selected, we're expecting to see support and resistance in that range there. And so typically what I do is just draw all these lines, and once I've got the horizontal lines on the chart, I'll then replace all of that with a channel to make a nice zone on the chart that I need to watch out for. A Donchian breakout method is actually one of the strategies mentioned in the book here. Basically what he's doing is looking at the past 4 weeks, what's the highest high in the past 4 weeks, and then when I get a breakout of that zone, where these arrows are, is where that happened, then I know that, the strategy that he talks about is buying on a breakout on the positive side, because if I've broken out on the past 4 weeks, well then statistically it looks like the market's going to go up, and then when I get a breakout on the downside, I will exit that trade. So it's a bit of a conservative model, this one. When you consider where the market went, so from the low all the way here up to the high, we didn't enter the trade until there, and we exited at that point. Yeah, it was a nice trade, but here's one that didn't work. We entered at this point and then we exited at that point. We would have lost on that. Again, so important. Any technique like this, anything that you're doing, anything you're learning about as part of this program with technical analysis, that you go through and test it. You've got to understand, is this a good method? Does this work? Is it something that is going to give good results? Does it work in the markets that I trade? Many of these techniques were developed by people who are trading a specific market, and it worked fantastically for them, but it may not work perfectly for the markets that you're trading in or that you're working in. So again, it's good to have that understanding, learn these techniques, and then make sure that you're able to apply them. All right, where are we? Support and resistance switching. The final point about support and resistance is that in all of these cases, whenever you have a price like this, what was once support can become resistance in the future, and what was once resistance can become support. So when you look at this line here, this green line, all those red arrows are places where the market bounced off this one price level. So we'd say, hey, that's a really strong support line. But then when you look at the green arrow, the market had broken down, broken through the line, the level, came back up and hit that level again, and then suddenly it became resistance. And so then the price fell away. Now, as time went on, you can see by the blue arrow, there was a little bit of a pause. We talked about that before as well, that often at these levels, even if the price doesn't reverse at that level, there was that slight pause, only really small. You can only just see that little bit of extra congestion around where that blue arrow is. But nevertheless, that again is something that we would consider, and a lot of people must have been watching that price level and looking to see which way the market would go there. So that's the trends, the support, the resistance. Very important. You're able to identify primary, secondary, tertiary, be able to know where to place a trend line, know the difference with an internal trend line, being able to identify support and resistance, and understand this switching between support and resistance as well. As always, any questions, send them through to us at the forum at forum.optuma.com, and make sure you log in. Got to log in with your same username and password so you see the appropriate forum that you can post your questions to. And other than that, we'll continue on in the next session. Thank you.